G entry would be that the production orders costing 520,000 according to their job cost sheets were completed during the October and transferred to finished goods. Means our finished goods is increased by 520,000 and our work in progress decreased because now things are transferred from work in process to finished goods. So finished goods account 520,000 to work in process 520,000. The last part is that the production orders 480,000 to complete according to their job cost sheet and they are shipped to customers, and these are sold on account, which means cash is not received yet. So we are going to create accounts receivable and the sale price is 25% above the cost. So we're gonna do it in two parts. One, that we're gonna shift this cost to our finished goods, that's this much worth of finished goods are sold, and then we're gonna create our account receivable, and because account receivable will ship the goods on sale, so our revenues also increase. So each part, the first part is we're gonna transfer this cost of goods sold to our finished goods. So this much worth of goods are decreased, so we're gonna charge it to income statement or to through cost of goods sold. So cost of goods sold 480,000 to finished goods 480,000. And then we're gonna increase our revenue. Revenue increases credit, and account receivable is increased. We call this debit side. So 25% more means we're gonna multiply this with 1.25. Answer would be 600,000. So 600,000 revenue or sales, 600,000. So here we have completed our first part, journal entries, and for the next part we're gonna move it to the next slide. Here it is. So just read it for a second and then we're gonna solve it together. Okay, let's solve it together. So it says they prepare e-accounts for manufacturing overhead and working process, and we have to post relevant information above to each account. So let me divide the screen, and one e-account we're gonna make it here for work in process, and one account we have to make for manufacturing overhead. So that is their debit side, that is their credit side, debit side, credit side. So let's post it, the entries here. So we have to go to the previous slides, and we know that from entry B, manufacturing overhead is debited by 12,000. From C, it is also debited by 110,000. From D, it is debited by 40,000 due to depreciation. From E, it is also debited by accounts payable, others, manufacturing overhead here. And from the F account, we applied the manufacturing overhead that is 240,000. So when we balance it out, this would be totaled. The balance here would be, this is 132,000 total amount, and this is 240,000. So the balance that would be carried forward here, 8,000. So 8,000. Why? Because this amount is total 232,000, and this amount is 240,000. So when we less it, this balance is 8,000 more. So at the end we transfer this balance to the next account here, 8,000. And now move towards the work in progress. So for work in process, we know that the work in progress beginning balance is here, balance is 42,000, right? So now let's post into relevant account. So we know that the B entry, from B entry, work in progress is debited to 178,000. From C, it is debited to 90,000. From F, it is to 40,000. Work in process apply from manufacturing overhead applied here, and from G it is credited to 520,000. And now let's solve this one. So here the balance would be 30,000 short. At the end, that balance will come to the debit side, and we're gonna start to the next one like this. The next working process ledger is going to be opened with the balance of 30,000. Okay, now moving towards our learning objective 5, which is apply overhead cost to work in process using predetermined overhead rate. So let's try to explore this learning objective, and that is the manufacturing overhead account is a clearing account, which means the actual amount of overhead incurred during the period on the debit side of the account will almost certainly not equal to the amount applied to the working process on the credit side here. So if the crux is that at the end of the year adjustment has to be made. If we estimated more than our actual one, then it means what we estimated are not according to our actual one, so we need to adjust accordingly. So when we apply overhead to a particular job, we debit work in process inventory and credit the manufacturing overhead. So amounts on the credit side of the manufacturing overhead here represents overhead applied, right? So in this case, if we apply more overhead applied here, so our work in process cost will be more. So it means at the end, if the actual and the applied manufacturing overhead are not equal, a year-end adjustment is to be made. And we have names for this adjustment. Either this is under applied or either over applied. So let's move towards the next slide and explore this concept further. The entry shows that the application of overhead to work in progress inventory. For applied overhead, we debited the work in progress. We also did it in our question that we just did before, question 314. We just had this entry. So when we applied the overhead, we debit the work in progress and we credit the manufacturing overhead. So the previous slides basically mentioned that how we can account for applied manufacturing overhead. The difference between applied and actual we're going to cover in our later slides. But before that, we are here learning the concept of accounting for non-manufacturing cost. So we previously discussed the treatment of selling, general and administrative salaries expenses during the period. So the non-manufacturing costs are not assigned to individual jobs, rather they are expense in the period incurred. So recall our discussion regarding period cost and product cost. So here non-manufacturing costs are charged to the respective expense account like marketing, selling and administrative in the period the expense was incurred, right? So here the examples are salaries expense of employees who work in a marketing, selling or administrative capacity, advertising expense or expense in the period incurred. So in this case, when the non-manufacturing costs of for the current P period occurred, for example here salaries expense, so we are going to expense it according to its salaries payable account or according to its own liability accounts. Sorry for that. So these general entries illustrate the expensing of non-manufacturing cost in the current period. So for example, salaries. I'm really sorry guys, please ignore this. So as soon as salaries expense incurred, so we create entry salaries expense to salaries payable. As soon as advertising expense incurred, so we create the entry advertising expense to accounts payable.